Welcome back to the deep dive. We are kicking off 2026, and the stock market seems to be having a massive New Year's celebration that just refuses to end.
It really does. I mean, we closed out 2025 with the S&P 500 up a really strong 16%.
And the NASDAQ, of course, powered by all that big tech, was up an even more impressive 21%.
And what's remarkable is the market's complete indifference to major events. You mentioned the rally continuing. It's just shrugging off things like the U.S. taking action against Maduro and Venezuela.
Oh, absolutely. A few years ago, that would send jitters to the market for weeks.
Genuine jitters, exactly. But now it's just treated as background noise. The rally just keeps on going.
It's shrugging off everything, and that tells us we need to look past the daily headlines. So
Yes.
we've gathered a stack of sources that look not at the day-to-day news, but at the deep structural, almost tectonic plates shifting right under the U.S. stock market. Our mission today is to synthesize 5 of these crucial long-term themes and then, hold them up against the most critical valuation metrics to figure out if this party is built on solid rock or if we're all just dancing on a very expensive pile of sand.
And the need for this deep dive couldn't be more urgent for you, the learner. We have a market that has run incredibly hot, hitting, historical valuation extremes.
The tension is palpable.
It is. Is this continued momentum proof of genuine structural strength, maybe driven by AI and tech, or is the market just running way, way ahead of any rational foundation? We have to understand these 5 shifts to even begin to answer that.
Exactly. And as we start assessing the market's temperature, we'll be talking about some crucial long-term indicators. One of the most telling, I think, is the Buffett Indicator.
The total U.S. stock market cap relative to GDP.
A classic. It's essential. It basically tells you how much the price tag of the entire stock market is, inflated compared to the country's actual economic output.
It's a superb health check. It really shows whether prices are tethered to economic reality or just floating on pure sentiment.
And if you want to track this vital metric daily to keep a pulse on that long-term valuation health, we really encourage you to check out the Buffett Indicator iOS app. It's available right now in the Apple App Store. It's a fantastic tool to keep you focused on the long game.
Okay, before we jump into the sources, just the mandatory note. All the analysis in this deep dive is based on publicly available sources. It's strictly for educational purposes, and it does not constitute investment advice. Please do your own due diligence.
Okay, let's unpack this structural story. We have to start with the biggest force shaping everything else, which is theme 1, the relentless, just absolute dominance of technology.
And our sources all agree this one theme is basically the root cause for the other 4.
The scale of it is just staggering. As of the end of 2025, the pure infotech sector alone, it's ballooned to 35% of the S&P 500.
35%. And that's the narrow definition.
Right. If we use a more realistic definition of tech, broaden that umbrella to include communication services, which, remember, now houses giants like Google and Meta, that combined weight hits 46%.
46%. That's a 10 percentage point surge in just 10 years, up from around 36% back in 2015.
And that's not even counting Amazon.
Not at all. If you reallocate Amazon out of consumer discretionary and put it in a functional tech bucket where it arguably belongs, the sector easily accounts for 50% or more of the entire index.
Let's just pause on the concentration for a second. When we zoom in on just the top players, how enormous are the top 3?
They are massive, and the concentration risk is, frankly, extreme. At the end of 25, the top 3 stocks were NVIDIA at 7.7%, Apple at 6.8%, and Microsoft at 6.1%.
That is just, it's unique to the U.S. market, isn't it?
By far.
Yeah.
It is the most tech-heavy developed market anywhere in the world. No one else is even close.
And this dominance isn't just about, a few successful companies making great products. It's deeply tied to the AI revolution.
That's the engine. The AI revolution has required this massive front-loaded capital investment capex. Companies are pouring billions into data centers, chips, infrastructure.
But here's the link I want to understand. How does that connect to the average person? The sources highlight this creates pressure on consumers.
Right, because that explosion of high-tech capex is creating financial pressure on the typical consumer and on the non-tech sectors of the economy.
Explain that. How does investing in a data center in Virginia affect my grocery bill?
It's about resource allocation and cost inflation. This immense capital spending drives up the cost of certain resources, specialized labor, energy, even industrial manufacturing capacity. It pulls capital and talent away from traditional consumer-facing industries. So when the biggest economic activity is all focused on enterprise AI infrastructure, it contributes to sticky inflation and affordability problems everywhere else. The consumer sectors feel that squeeze.
Which brings us perfectly to themes 2, 3, and 4. The idea that the market is becoming unmoored from everyday consumer life.
Exactly. These themes all point to the same thing. Traditional consumer stocks matter less, the market is less driven by them, and so the stock market is essentially unmoored from the average person's financial reality.
Wait, but if 70% of U.S. GDP is still consumer-driven, how can the market really power through a consumer crisis? Doesn't that structural disconnect have to break eventually?
That is the critical vulnerability. But for now, the market is structured to basically ignore the problems of the K-shaped economy.
So think about where consumers are facing the most pain.
Yeah, think about it. Rising healthcare costs, housing, even staples like detergent. The market just doesn't feel this pain anymore because those sectors have been marginalized.
It's jarring. I mean, the problems you might be talking about at your kitchen table utility bills, the cost of groceries, they're almost completely irrelevant to how the S&P 500 is behaving day to day.
And the data is just stark evidence of this. If you look at the combined rate of healthcare, consumer discretionary, and consumer staples,
The core consumer stuff.
the core stuff,
Yeah.
in 2015, those sectors were 38% of the S&P 500.
A huge chunk.
A huge chunk. By the end of 2025, they were down to only 25%. That 13-point drop shows you exactly where the market's focus has gone, away from the consumer.
So the core implication is pretty clear. Even if that K-shaped economy gets worse, or if the traditional economy stagnates, the market might just power right through.
It might. The only requirement is that the current tech and AI trends remain fully intact and keep growing exponentially.
And that leads directly into our fifth and final structural theme, which is really the accelerant for all the others.
The overwhelming dominance of passive investing.
Index investing is just a colossal force now. We're talking 60% of all equity market flows.
And think about what that 60% is actually doing. The indices are weighted by market cap, right?
Yeah.
So the biggest companies get the biggest weighting. This massive flow of passive money just ensures that structurally, the big get bigger.
It's all computerized.
Entirely. An index fund's job isn't to judge value, it's just to replicate the index. No passive manager sits down and goes, maybe NVIDIA is a bit overvalued. They just buy it in the required ratio, period. No judgment.
And this structural reality, it puts active managers in a really tough spot. The sources call it the too big and too little problem.
It's a profound dilemma. The too big problem is all about institutional risk. Imagine you're an active fund manager. You have strict rules.
Like a cap on any single stock.
Exactly. A rule that says no single stock can be more than, say, 5% of the portfolio. So if a mega cap tech stock you own just skyrockets and it grows from 5% to 8%, you're forced to trim it back down to 5%.
You're forced to sell your winners just because they got too successful.
Precisely. This forced realization of gains means you have to systematically underweight the fastest growing sector tech relative to the index. So if tech keeps winning, the active manager keeps underperforming.
Which drives more money out of active funds and into passive ones.
It's a devastating feedback loop.
And the flip side of that coin is the too little problem, where all the small non-tech sectors are just neglected.
Totally. The 5 smallest sectors, staples, utilities, materials, real estate, energy combined, they're only 14% of the S&P 500.
It's nothing.
Take real estate. It's barely 2% of the index, made up of 31 companies. If you're a big generalist manager with limited research time, why would you bother?
Right. Why spend time on a tiny sector where even if you're a genius stock picker, it barely moves the needle on your overall performance?
You don't. You focus on the 35% infotech sector instead. It guarantees the small sectors stay small and starved of capital.
Okay, so passive dominance is reinforcing this concentration. But has it completely broken price discovery? Does a stock's price even mean anything anymore?
That's the big fear, but the sources offer a great counterpoint. The Oracle example.
Right.
Oracle announced this colossal $500 billion backlog. The stock initially surged, a classic passive headline-driven response. But then the 40% of active money kick in.
The people doing the homework.
The people doing the homework. Active managers dug into the fine print and realized that the capex for that backlog would be funded by debt, not cash flow, which completely changes the risk profile.
And what happened?
The stock corrected. Hard. Almost immediately. And that rational, rapid correction proves that price discovery is still alive. It's being driven by that critical 40% of active flows. They are the market's sanity check.
That's a great example. So now we understand the structural engine. It's concentrated, it's tech-heavy, it's passively reinforced. How expensive is the ride right now? Let's switch gears and check the valuation temperature.
And they are priced for, well, flawless perfection based on almost every long-term metric we have. Let's start with the Buffett Indicator, market cap to GDP.
As of early 2026, where are we?
It's reading around 220%.
220%. Give that some context.
Well, 100% is often seen as fair value, so 220% it's extremely high. It's on par with or even above previous record peaks. It signals an acutely overvalued market.
In models based on that starting point,
Yeah.
they don't look good.
They predict near zero or even slightly negative long-run annual returns over the next decade. That is a loud, loud warning siren.
And the Shiller PE, the TPE ratio, is it telling a similar story?
An identical story. The CHE is at 40 to 41. Again, for context, this is the second highest Shiller PE ever recorded.
Ever. What was number one?
The only time it was higher was the absolute peak of the dot-com bubble in 2000 when it hit about 44. A CAPE in the low 40s just screams that investors are pricing in uninterrupted, flawless growth for years.
So if valuations are at these extreme highs, you'd expect investor sentiment to be manic, right? Euphoric, reckless. But here's the huge contradiction. Sentiment is actually calm.
That is the fascinating disconnect. It's maybe the source of the market's complacency, the fear and greed index. It's sitting right in neutral territory around 46.
So not fearful, but not greedy either.
Neither. They appear cautiously optimistic, almost serene, which is strange.
And the VIX, the volatility index, that confirms the calm. It's low, right? Mid-teens, 15 to 16. That signals complacency. The market is just not expecting turbulence, despite sitting on these historic valuations.
And this calm is partly helped by the interest rate backdrop. The Fed did those 3 rate cuts in late 2025.
Right, bringing the Fed funds rate down to 3.50% to 3.75%.
A more dovish backdrop. But you still have the 10-year Treasury yield elevated at 4.1% to 4.2%.
True, but the yield curve is normalized. That's a big deal.
It's critical. Short rates are now below long rates, an upward sloping curve. That's a classic sign that the market sees lower near-term recession fears and expects modest growth. It keeps sentiment calm, even at these crazy prices.
Okay, we've tied the structure to the valuation to the sentiment. Let's identify the powder keg. What is the big risk when you mix passive flows and extreme pricing?
The risk is the velocity of the decline. If there is ever a serious recession or if the main driver AI spending falters, the selling will be fast, it'll be unified, and it will be ugly.
Passive index investors just hit sell.
And the funds themselves automatically liquidate those huge concentrated tech positions.
And because of the concentration, the biggest weights will drop the hardest, amplified by the very mechanics that made them so big in the first place.
Exactly. And there will be very few buyers on the other side willing or even able to step in quickly enough. The sources point to that 19% correction we saw last year as a potential replay. But a genuine break in the AI story could make that look mild.
To bring this home, let's look at a real-world example, PayPal. It really illustrates how the market just punishes companies that don't fit this structural narrative.
PayPal's story is such a stark warning against falling into a value trap. I mean, the stock peaked at $289 in 2021. End of 2025, it was at 58 decline.
An 80% decline. And the confusing part is the earnings. The company beat estimates, grew 21% in 2024, expected 15% in 2025. Yet the stock was down 31% in 2025 alone. Why the massive disconnect?
It's franchise value erosion, plain and simple. The market narrative has shifted. Skepticism is intense about its long-term competitive moat.
Unlike Visa or MasterCard, whose networks are almost impossible to challenge.
Exactly. PayPal is constantly under siege from new entrants, from shifting consumer habits. So even with a low PE multiple, maybe 10 times 2026 estimates, the market sees a potential value trap. The price reflects doubt that it can sustain its profitability no matter what the short-term earnings say.
The market just doesn't reward earnings growth if the structural long-term story is crumbling.
It doesn't. PayPal is structurally irrelevant to the mega cap concentration story, and it's being penalized for that competitive weakness.
So what does this all mean for you, the learner? Let's synthesize. The U.S. market is fundamentally changed. It is tech-dominated. It is unmoored from consumer reality. It's sitting at extreme historical valuations. And yet it's exhibiting this bafflingly calm sentiment.
And the final provocative thought is this. The market is betting heavily, almost entirely, on the sustained, uninterrupted success of the AI revolution. But the index structure itself ensures that when the correction comes, the speed and the severity of that decline will be amplified by the very passive flows that drove the bull run up. The structure itself is a mechanism for a very rapid, very volatile move to the downside.
If you found this deep dive valuable and you want to access more advanced content on these structural shifts, we'd welcome you to join the Deep Value Club membership.
And you can also subscribe to the channel Deep Value Investing on Apple and Spotify podcasts or visit luluvc.com.
As always, remember, all analysis is based on publicly available sources and is for educational purposes only. It does not constitute investment advice. Please conduct your own due diligence. Thanks for diving deep with us. We'll see you next time.